G'day guys, welcome back to Harpel Financial Group with the latest market update, coming to you off the back of some downturn, obviously lately with some goings on around the world. So we'll touch on the Israel and Hamas-Palestine conflict that's going on there and what that means for oil prices and inflation. The other thing, I guess, is just touching on bond prices. So bond prices are meaning the long-term or the short-term interest rates that we're expecting. So they look at the markets look at a 10-year bond horizon. So in Australia and in America, for example, the 10-year bond price in America struck 5% the other day. What that means is the borrowing capacity, or what the market is believing interest rates may be for a longer period. So what we're currently seeing at the moment is the market is pricing in to say, well, we're feeling that from the central banks and from the dialogue and conversations that have been had, is that interest rates will be higher for longer, quote unquote. So what that means is that the 10-year bond average remains a bit higher and remains heightened. What that means for shares, just generally in the markets, is that borrowing becomes more expensive. So then the risk-free rate, which is the risk-free rate of interest rates you can get on bonds, as opposed to what return you can get on shares, which is the riskier asset, starts to have an evening out effect where the risk-on rate to buy those shares isn't as attractive as it might have been if the bond prices were a little bit lower, that risk-free rate. So what that means is, I guess, they're sort of talking about comparisons to 1987. 1987 is where we had larger bond increases and we had a market rally into that. So there's a few similarities that are there and caused a bit of a stock market crash, but also some differences too. And even still with, I guess, the 1987 crash, the markets and the economies tended to turn around really quickly the following year. So it was, again, looking back at that graph we sent the other month, that's a short-term blip on the long-term radar of markets in general. I guess in terms of what we're seeing that and some of the areas that we're seeing in terms of the bond pricing is the deteriorating risk premium, which I've spoken about just earlier. The bond yields in Australia are the highest they've been since 2011, and the US bond yields are the highest they've been since 2007. So going back a fair way now to get these bond prices where they're at. So some of the other things, or some of the other mixes into the concerns, is there's still a high risk of recession in the US, and recession is one of those words. It's a bit scary, but its just definition is 2 consecutive quarters of negative GDP or growth. Sluggish growth in China, and worries about just the property sector there in general. Some messiness in US politics, which is nothing out of the norm, pretty standard. Always something happening in the American politics, which then causes an impact or an unsettling of one of the biggest economy in the world, which then has a ripple effect to other countries like us. And then the oil prices, so surging in oil prices on the back of production cuts. And then fears that may be made worse by the war that's occurring now. The tragic war that's occurring now in Israel and Palestine. So I guess in terms of how that threat then impacts on the market. So, it's a terrible situation, and what we're seeing over there and many lives lost. But in terms of how it's impacting the market, I guess it's currently just isolated to that area, and it hasn't brought in other countries, which can then impact things like oil supplies and inflation. So there's many, the Arab countries on the sidelines still. So the contagion risk is not there just yet. It's still isolated. However, if Iran were to come in and back Hamas, that gets drawn into conflict, which can then have an issue in terms of that contagion effect that we spoke about before, and that's when you might see some potential issues with oil supply concerns, which then leads to the petrol tank and the Bowser, where we can get large increases of petrol prices. In 87, I think they quadrupled very quickly because of the issue back then. It was either 87 or in the 70s with the oil crisis, I should say. So far, the market reaction to the conflict has been relatively modest in terms of the shares. So they're little affected, with oil prices up, only 4%. So still below the recent highs. And if a conflict, contains to Israel, the impact may be largely minimal. And if not, it may flow onto larger, higher petrol prices. 18 months ago, oil prices surged off the back of the Ukraine-Russia war. So there can be similarities in regards to that, because consumers then have to wear the higher petrol prices because of that. I guess this time around it can be a little bit different as the reopening boost. So we're sort of opening up now. So monetary policy is tight. So budgets are under constraint. So there's less of that bigger spending, or people are tightening the purse strings a little bit. So I guess the rise in petrol prices, it'll be a tax on spending. Fuel is one of those things that's hard to avoid. It's generally what we call a non-discretionary expense. But on average, the household weekly budgets and notes here is the fuel bill's already up about $12 per week since May. So, household budgets are already stretched, so it means a further hit to consumer spending. So, and that will have a ramification to inflation. One of the articles I was reading before that, the inflation ramification is there, but then oil and energy prices only account for about 1.7% of core CPI. So even if there was to be hikes, significant hikes in petrol prices or oil prices, or have them held on for a longer time, the underlying impact of inflation wouldn't be too significant in the grand scheme of things, because it's not a huge makeup of the core CPI. It's about 1.7%. So that's probably the main area from today. Some of the positives, I guess, to take out of the markets, because the markets in general have started the year fairly well. The US probably more so than Australia. Australia's lagged a bit. We're probably more of an attractive position from a market perspective because of our economy and our makeup and our segregation to the world and diverse landscape of different services and products. But in saying that, we'll also have that contagion effect if the US, sneezes, everyone else catches a cold. So if the US potentially has to threaten to hike again, we might have to be, threatening position to hike again, or that'll impact our markets as well. But some of the positive things, I guess, to end on this is seasonality. So towards the end of the year can become sometimes more positive. Inflation is likely to continue to fall. So even with all the inflation pressures that have gone on, we're still hopefully seeing that likely to fall, and that'll take the pressure off some of the central banks and maybe give them the ability to start easing towards the second half of next year. So early indications was going to be maybe easing in the first part of 2024, but now we're less likely to see that, and we might start to see them talking about it towards the second half. Any recession likely to be mild, given the absence of that excessive prior spending. So hopefully a mild recession if it does happen, or none at all. So the 12-month view on shares still remains optimistic, and just growth assets in general. And then I guess there's a bit of an epilogue there. So the 1987 crash, which was the bond crash that we saw, it did seem to be forgotten about pretty quickly in 88. So all economies, the US and the global economies, did really well in that following year. So little impact from the share crash. So just generally keeping mindful of the short term when things are going through it and there's volatility. That long-term picture is always really important. So I know I harp on that about that a bit, but it is super important just to really have a good understanding that it's that long-term approach and that view we take, which helps keep the steadiness of the ship, even though we're going through market situations that are volatile. With all things being equal, we want to allow things to take their time and to continue to be not too emotional, and just stand the test of time and work through the markets as we go. Any questions, as always, feel free to reach out. Always here to help and talk through any situations that we're going through. Take care, and we'll look forward to catching up with you guys soon. Bye for now.